Everyone else is scanning the same headlines, watching the same charts, and copying the same trades. So why are you still surprised when you end up with the same average results? The edge isn't in working harder inside the crowd. It's in finding the door nobody else is even looking at. Asymmetric risk reward means you're risking $1 to potentially make 5, 10, or even 20. And the secret is that these setups exist precisely because most people are too rational, too comfortable, or too distracted to touch them. The market doesn't misprice things randomly. It misprices things emotionally. And that emotion is your raw material. Think about 2008, 2020, or even the meme stock chaos of 2021. In every single case, someone was quietly loading up while the crowd was either euphoric or terrified. The asymmetric trader isn't smarter than everyone. They're just operating on a different emotional frequency than the herd. The catalyst for most mispriced opportunities is actually narrative overcorrection, when the story around an asset becomes so negative, so uniformly bearish, that the price has already priced in the apocalypse, but the apocalypse never quite arrives. That gap between catastrophic expectation and merely bad reality is where asymmetric returns are quietly born. Most people look for certainty before they act, but certainty is the enemy of asymmetry. By the time everyone agrees something is a good trade, the easy money is already gone. You want to be buying the whisper before it becomes the headline. And that requires getting genuinely comfortable sitting in uncertainty while everyone else is running away from it. Here's where it gets tactically real. You look for situations where implied volatility is pricing in a disaster that has, say, a 15% chance of actually happening, but the options market is charging you as if it's a 60% probability. That mispricing and volatility, not just price, is one of the clearest signals that the crowd's fear has outrun the actual math. A lesser known tactic is what traders call the orphaned asset. Something that used to be loved, got abandoned after one bad cycle, and now sits completely off the institutional radar, despite fundamentally unchanged or even improved underlying value. Nobody writes about it, nobody covers it on the big finance channels, and that silence is actually the loudest buy signal you will ever hear. People confuse asymmetric trades with lottery tickets, and that misconception costs them everything. A lottery ticket has a terrible expected value baked in from the start. A true asymmetric setup has a positive expected value hidden underneath surface level ugliness. That distinction is the entire ballgame. Sizing is where most people ruin an otherwise brilliant asymmetric thesis. They either bet the house because they're convinced, or they take such a tiny position that even being right barely moves their portfolio. The discipline is betting enough to matter if you're right, while losing only what you can emotionally and financially survive if you're wrong. History tells us over and over that the best asymmetric trades feel embarrassing to hold in the short run. Think of anyone who bought Amazon in 2001, or Apple after the near bankruptcy years, or Bitcoin before anyone on television had heard of it. The crowd isn't just indifferent to these setups. They're actively mocking them, and that mockery is ironically one of your best confirming signals. You also want to look for structural asymmetry, not just price asymmetry, meaning situations where the rules of the game itself are tilted in your favor, like a spin-off that institutional funds are forced to sell for mandate reasons, not fundamental ones. When forced sellers meet patient buyers, that's not just a trade, that's practically a treasure map. Process beats conviction every single time. In this game, you can be 90% sure and still size wrong, exit wrong, and lose money, while someone who was only 60% sure, but executed with discipline and patience, walks away with generational returns. The asymmetric mindset is less about being right and more about engineering situations where being wrong costs you little and being right pays you enormously. At the philosophical level, this entire pursuit is about accepting that the market will humiliate you regularly and building a system so robust that even your losses are structurally manageable and your wins don't require perfect timing. Discipline, sizing, and consistency aren't just principles. They are literally the only variables you fully control in a game designed to strip those very things away from you. If you can genuinely say, I am comfortable being wrong here because my downside is capped and my upside is open-ended, then you are not gambling, You are operating exactly the way the most quietly successful traders in history have always operated. That mental comfort with any outcome, built on rational preparation rather than blind hope, is the final underrated edge that almost nobody talks about. Whether you're looking to apply asymmetric thinking to real estate investing, contracting opportunities, or finding the right lenders to back your next move, check out the links in the description below. We can help you get started.